discussed what are the various kinds of companies, let us now start discussing what is minimum alternate tax. This is a tax which is definitely an alternate tax, which is not mandatorily to be paid in all cases by all companies. But this is a tax which is required to be paid only by companies. Minimum alternate tax. In the last class, we had discussed about alternate minimum tax. Now we are discussing about minimum alternate tax. Is, as I said, it is applicable only on companies. The section which is applicable is section 115JB, a very, very important section, because many a times in the examination, you are not asked to calculate minimum alternate tax. You're required to calculate tax under section 115JB. So that is why you should be knowing this section very well. This is section 115JB. As per this section, in case there is a company which is to pay, every company has to pay tax at the rate of 30%. But if the amount of tax when calculated at the rate of 30%, which is your regular tax, if it is less than 18.5% of the book profits, in that situation, company has to pay whichever is higher. So in that situation, company has to pay 18.5% of the book profit. Is the point clear? If assuming that the total taxable income of the company is say rupees 100, on that 100 rupees, company has to pay 30.9% of the tax. So we say that 30.9 rupees is the tax which the company has to pay. Now, if the book profits of the company is say rupees 200, now on this 200, now you will calculate 18.5%, that is 37 rupees. Now 37 rupees is more than 30 rupees. So in that situation, company has to pay minimum 37 rupees and not 30 rupees. Same concept that we saw in case of alternate minimum tax, right? I would be discussing section 115JBB also. Minimum alternate tax is under section 115JB. 115JBB talks about the minimum, the MAT credit, which I would be discussing with you. Now, this amount that you are paying as minimum alternate tax, this amount can be the excess, that means the difference between 30 and 36, as I discussed with you, and 37 as I discussed with you in the last class also with respect to alternate minimum tax. So this 7 rupees you can carry forward for the next 10 assessment years, and which can be adjusted if in the next year your regular tax is more than the minimum alternate tax. Same concept as I have discussed already with you in alternate minimum tax. Now, why this particular tax was introduced? Why MAT came into existence? What was happening in case of many companies, and more particularly Reliance Industries Limited, what was happening, the company was having substantial profits. It was paying large amounts of dividends to its shareholders, but it was taking the benefits of various deductions which are available under the Income Tax Act, and it was reducing its taxable income to a very low level. So the government felt that if the company has got such a surplus cash flow that it is paying dividends it can pay dividends to its shareholders, why can't it pay a minimum amount as a tax? So therefore, the provisions of section 115JB was introduced, and the companies were required to pay minimum alternate tax. So now, since the time the section 115JB has been introduced, every company is required to calculate both the regular income tax and the minimum alternate tax under section 115JB. So the profit which is computed under the regular provisions of the Income Tax Act are called regular profit, and the tax is called a regular tax. And the profit which is computed under section 115JB is called a book profit, and the tax is called minimum alternate tax. So every company is required to calculate both the taxes every year, and whichever is higher, every company is required to pay that. Yes, of course it is mandatory. This is mandatory not only on the domestic companies, it is mandatory also on the foreign companies if they have any permanent establishment in India. If a foreign company has got a permanent establishment in India, it is also required to calculate minimum alternate tax. So the computation is very simple. You have to find out 18.5% of the book profits, compare it with the total income tax, and whichever is higher has to be paid. Section 8 companies have to pay which tax? Now, Section 8 companies are no profit making companies. So, therefore, if there is no profit, there is no tax, right? But in that situation, companies have to, because these companies are registered for charitable purposes, so these companies have to get themselves registered under the Income Tax Act also, under Section 10, subsection 23 of the Income Tax Act, if I'm not wrong about the subsection. So they have to get themselves registered and they have to seek exemption under the Income Tax Act as well. So therefore, they are not required to pay MAT, they're not required to pay regular tax as well. Now, if we add the surcharge, etc., to the minimum alternate tax, so if the book profit is not more than rupees 1 crore, then there is no surcharge. So, company has to pay 18.5% minimum alternate tax, and on that 3% cess, so that makes it 19.00055%. But if the company has to pay, if the book profit is more than rupees 1 crore, then company has to pay 5% surcharge also in case of domestic company, and 2% surcharge in case of a foreign company. So we add the surcharge on the tax and then we add education cess, so that makes effectively the rate to be 20.0075% in case of a domestic company and 19.4361% in case of a foreign company. Similarly, if the book profits are more than rupees 10 crore, then the rate of surcharge is 10% in case of a domestic company and 5% in case of a foreign company, and the rates are automatically calculated. This I've already discussed, that these are the provisions of section 115JB are applicable to foreign companies, but in that situation the foreign company must have a permanent establishment in India. Earlier, the MAT provisions, the minimum alternate tax provisions, were not applicable on the incomes which are coming from special economic zones. Now, since 31st March 2011, these provisions are now applicable even to the companies or the businesses which are in the special economic zones. But these provisions are still not applicable on the companies which are shipping companies, which are subject to tonnage tax, which is the presumptive taxation for shipping companies, and for companies which are into life insurance business. So these are the companies which are still not required to pay minimum alternate tax. Otherwise, all the companies are required to pay minimum alternate tax. Now, just to give you a small computation, if the book profits of a company in the previous year 2014-15 is say rupees 15 lakhs, and if the total income computed as per the provisions of Income Tax Act is rupees 3 lakhs, then can you calculate the minimum alternate tax and the regular tax for the company? Simple calculation. 15 lakhs book profits and regular income of rupees 3 lakhs. Can you calculate MAT and can you calculate the regular tax? Very simple question. 92,700 rupees is your regular tax. And what is your MAT? MAT is 2,85,825. Fantastic. In both the cases, you have included education cess, right? Now, in these two cases, which is higher? Higher is MAT. So you would be paying minimum alternate tax. And the difference between the two, which is 285 minus 92,700, is the amount of tax credit that you can claim. So the MAT credit is available of rupees 1,93,125, right? And this is the amount that you can utilize for the next 10 assessment years. Now the question is that how do we calculate this book profit? This is something which is a very, very important computation, because, and this is the beauty about this particular provision, is that whatever has been given in the law, you just have to make those adjustments. Don't make any adjustments which are not given to you in these adjustments, right? So what you will do is, in order to calculate book profit, pick up net profit as per profit and loss account. While we were calculating adjusted total income in case of calculating alternate minimum tax, we started with total income as per Income Tax Act. Here you're not doing that. Here you're starting with net profit as per profit and loss account. So the difference should be clear. While calculating adjusted total income, you have to pick up total income. While calculating book profit, you have to start with net profit as per profit and loss account. Then you have to make 8 positive and 9 negative adjustments. And the resultant would be the book profit. So you have to add 8 things and you have to reduce 9 things. What are these 8 things and what are these 9 things? I'll be coming to this slide little later. Yeah. What are these 8 positive adjustments? What are these 8 positive adjustments? You will pick up the net profit as per profit and loss account, and to that you will add the amount of income tax paid or payable and any provision therefore. You will add the provision for income tax, you will add the amount of income tax which has been paid, or in case it is income tax payable which has been debited to the profit and loss account, you will add it back. Right? If it has been debited to the profit and loss account, you will add it back. Now this income tax will also include the interest on income tax, but it will not include wealth tax. It will not include indirect taxes, right? It will include dividend distribution tax. So the definition of income tax here should be very clear. It includes interest on income tax. It includes dividend distribution tax. It includes provision for income tax. It includes income tax payable, but it does not include wealth tax. It does not include a commodity transaction tax. It does not include securities transaction tax. It does not include any kind of indirect taxes. Is the point clear? So whatever is included has to be added back. Whatever is included, it has to be added back. Whatever is not included, there is no adjustment for that. You don't have to do anything about it. Okay? Is it clear? Now the second adjustment. Amounts carried to any reserves by whatever name called. I'm not hearing anything from Abhija, Nimita, Seema, and Arpita. I'm not hearing anything from you. I hope the points are getting clear. I hope I'm not going very fast. Okay. So now the second adjustment that we have to make is we have to add back the amounts which are carried to any reserves. We have to, in case, while preparing your profit and loss account, you have carried any amount, you have transferred any amount to any reserve, right? So you will have to add it back. You will have to add it back. Any amount which is set aside to provisions made for meeting liabilities other than ascertained liabilities. So any provisions for unascertained liabilities have to be added back. Any provision for unascertained liability has to be added back. Just remember, amount of income tax, amount transferred to reserve, any provision made for unascertained liability has to be added back. Any amount by way of provision for losses of subsidiary companies have to be added back. I would be taking a lot of examples. Okay, if you want to take an example of any amount which has been transferred to any unascertained liability, that is like any liability for which you're not very sure whether that liability will actually arise or not, right? If it is not based upon any kind of valuation, if it is any provision that has been created just like that, without any logic, without any assertion. Yeah, contingency, yes, of course. But for contingent liabilities, we generally do not create any provisions, isn't it, Seema? For contingent liabilities, even the accounting standards do not permit, and this net profit has to be as per accounting standards. The net profit as per profit and loss account should be as per accounting standards. Now these are certain unascertained liabilities which can be there, and like, provision for gratuity. Let me give you an example. If I say provision for gratuity, every year every company creates a provision for gratuity. But if the provision for gratuity has been created after getting a report from the actuarial, I would be coming to provision for bad debts as well, but let me first finish with this. If once I say If the provision for gratuity has been created by actuarial valuation, then it is a certain liability. But if the provision has been just created without any actuarial valuation, then it is an unascertained liability. Coming to provision for bad debts, this is one particular situation which has been discussed a lot in judiciary as well. Provision for bad debts. Now, what is this provision for bad debts? Is it a liability? Is it a liability? No, it is not a liability. Provision for bad debts is not a liability. So it will not come under this clause. Why it is not a liability? Because it is an adjustment against an asset. You're getting my point? Just go to the depth of accounting. How do we write provision for bad debts? Debtors less provision for bad debts. Is it getting clear, Nimitta? So it is not a provision. It is not a liability. What to say of whether it is a certain or uncertain. But are we not going to add this provision for bad debts? The court said that no, you cannot add the provision for bad debts under clause 3. So then an amendment was made. And a new clause number 8 was added, which said no, just one second, not clause number 8, there was one more clause number 8 only, which says that the amount of deferred tax or provision thereof, or the amount or amount set aside as provision for diminution in the value of any asset. Now this provision for bad debts is a provision which has been created as a provision for diminution in the value of any asset. So it will be added under clause 8. You getting my point? You're getting my point? It's a provision for diminution in the value of any asset. So this is clear. Now we were on point number 3. So point number 3 is clear. Now coming to point number 4. It talks about amount by way of provision for losses of subsidiary companies. We're going to add it back. Amount or amounts of dividends paid or proposed. So any proposed dividend, any dividend paid has to be added back. Amount or amounts of expenditure relatable to any income to which section 10 or 11 or 12 apply, because these are exempt income. These are exempt income, so we will have to, any expenditure related to that has to be added back, because the incomes will also be reduced. So that's a fair deal, no differences in that. Amount of depreciation, any depreciation that you had in the books, whether it was normal depreciation or revaluation depreciation, just add the complete depreciation while making 8 positive adjustments. The point number 8 we have already discussed. Amount of deferred tax or provision thereof, or amount or amount set aside. Do you know what is provision for depreciation? Yes, of course it has to be added back. It has to be added back, right? So now coming to what is deferred tax and how do we calculate it? I was coming to that only. Deferred tax is a very interesting concept. I'll explain how. See, what happens that there are certain clauses in the Income Tax Act which does not permit you to claim certain expenses in a particular year. Like, there is a provision under section 43B of the Income Tax Act which says that in case there any government dues have to be paid by the company, in case there are any government dues which are to be paid by the company, if the company does not pay these dues, the government dues are like the amount which has to be credited to the provident fund account, the amount which has to be paid as customs duty, income tax, sales tax, any indirect taxes which are required to be paid. These taxes have to be any employee state insurance corporate contribution. These all dues have to be paid before filing return of income. If you do not pay these dues to the government before filing your return of income, then you cannot claim them as an expense, and they are going to be added back while calculating the taxes. But you would be able to claim them as an expense in the next year when you actually pay these dues. Is it clear? Now what is happening is that it is, you are in the first year you are paying a higher tax because you're not able to claim certain expenses. In the next year you are you are paying lower tax. You getting my point? So what is happening? You are deferring the tax payment. Rather, you are not deferring, you are prepaying the taxes. So it can be a deferred tax asset or a deferred tax liability. In some cases, like, you get a 200% deduction for scientific research expenditure, or you get 100% deduction for capital expenditure in certain cases under Income Tax Act. So what you are doing, you are reducing your tax liability, you are deferring the tax to the future. You're getting my point? So these are called, these are, there is a complete session I can take on deferred tax liability and deferred tax asset. But what I want to say is that in case there is any deferred tax, or in case there is any provision of deferred tax, that amount has to be added back while calculating the book profits, right? So that is what is deferred tax all about. When you delay the payment of taxes, then you create a provision for deferred tax. Whenever there is a delay in payment of taxes, so you create a provision for deferred tax. That provision has to be added back. Okay, Rajesh, is it clear? Is it clear? Okay. Now that there's another adjustment which has been added to in the 8 positive adjustments, it has been included under clause 8A. It says amount standing in revaluation reserve related to revalued asset on retirement or disposal of such asset. Now, what do I mean to say by that? What do I mean to say by that? I will have to open up, I think, my whiteboard in order to discuss this. Balance sheet of a company. Now, supposing you have a balance sheet of a company. In this balance sheet, here you have the liabilities, and these are your assets. Now, these assets contain some fixed assets like plant, machinery, land, building, etc., etc. Right? And this has got a particular balance which is equal to the liability side of the balance sheet. Now, supposing you purchase this land, building, etc., long time back, and you want to revalue your land, building, etc. Supposing it was for rupees 100 and the building was for rupees 50, and you decide to revalue it. And after revaluation, you want to make this 100 as say 1000 and 50 as say 500. So you have revalued your assets from 150 to 1500. So there is an increase in the asset side of rupees 1350. There is an increase in the asset side of rupees 1350. So how will you balance the balance sheet? You will create a revaluation reserve account here on the liabilities side. You will create a revaluation reserve account of rupees 1350. Is it clear? This point is clear? Now, every year, now you will be charging depreciation not on land but at least on building. You would be charging depreciation. Now, when you charge depreciation, you will charge a normal depreciation on rupees 50. You can, or what you can say is, you can charge a normal depreciation and you can charge a revaluation depreciation. You will charge a revaluation depreciation because original asset, the book value was 50 rupees. So original depreciation was say rupees 5 and revaluation depreciation is rupees 50. Right? When you charge original depreciation, you will create a accumulated depreciation account. Right? But when you charge revaluation depreciation, so original depreciation goes to the profit and loss account. So I'll make a profit and loss account here. Now, every year in the profit and loss account, what you will do, you will charge a normal depreciation of say rupees 5 and you will charge a revaluation depreciation of rupees 50. Okay? Now, normal depreciation will get reduced from the building account here, and revaluation depreciation will also get reduced from the building account. Okay? But actually your profits and losses have not reduced. By charging revaluation depreciation, if you charge rupees 50 as revaluation depreciation, you would be reducing your profits tremendously. So in order to handle this situation, the accounting standards say that you must withdraw from the revaluation reserve an amount equal to the revaluation depreciation. So from the revaluation reserve, you can withdraw from the revaluation reserve, you can withdrawal from revaluation reserve of rupees 50. Now thereby whatever you are showing is the actual profits, right? Your profit and loss account is not impacted because of revaluation, and your revaluation reserve this year will get reduced by, sorry, your revaluation reserve this year will get reduced by rupees 50, right? It will get reduced by rupees 50. Now many a times what the businesses do, in order to pay high amount of dividends to their shareholders, they charge they withdraw a high amount from the revaluation reserve rather than and as compared to the revaluation depreciation. They can do that. They can manipulate by withdrawing a higher amount from or a lower amount from revaluation reserve. Ultimately what will happen, when the asset will get sold, in that situation there might be some balance in the revaluation reserve account. When the asset will finally be sold, there would be some balance in the revaluation reserve account. Now this revaluation reserve amount, if it has got any balance when the asset has been retired or the asset has been disposed of, that balance will be added back to the 8 positive adjustments. That balance will be added back to the 8 positive adjustments. Is the point clear? Is the amendment clear? Okay. So that is what has to be. These are the 8 positive adjustments. Once you've done these 8 positive adjustments, we will come to the 9 negative adjustments. What are these 9 negative adjustments? The 9 negative adjustments are saying that in case any amount has been withdrawn from any reserve, which reserve, and this reserve was created earlier by debiting the profit and loss account, now you are withdrawing any amount from that particular reserve and you are bringing it to the credit side of the profit and loss account, then we have to reduce that amount because we want to know the book profits. We want to know the book profits. So any adjustments, if it has been made in the book profits, we will like to reduce, we would like to remove those adjustments. Like we did in the case of additions, any amount of income to which provisions of section 10, 11 or 12 apply, we are going to reduce that income as we've added back the expenses. Amount of depreciation which has been debited to the profit and loss account. Now this is the depreciation as per Companies Act only. So the depreciation which you had earlier added, now you're going to reduce that. Depreciation which you had earlier added, the normal depreciation you're going to reduce, but not the revaluation depreciation. You're going to reduce only the normal depreciation. In case it is again going to go, the connect say is that one is the normal depreciation you have to reduce. Yeah, from the beginning. Okay, the first negative adjustment is that if there is any amount which has been withdrawn from any reserve, you will be reducing that amount if the reserve from which the amount is getting withdrawn was created earlier by debiting the profit and loss account, right? So basically we are looking for book profits. Second is, in case there is any income which is exempt income under section 10, 11 or 12, you're not going to you're not going to charge tax on that, so therefore you will have to reduce it under the 9 negative adjustments. Thirdly, the normal depreciation you are going to reduce as per Companies Act. Whatever is the depreciation as per Companies Act, you can reduce that. Fourth is, you will now reduce the revaluation depreciation subject to the condition that you will reduce the revaluation depreciation or withdrawal from revaluation reserve, whichever is lower. Revaluation depreciation or withdrawal from revaluation reserve, whichever is lower. next adjustment that you have to make is you have to reduce the amount of loss brought forward before depreciation or unabsorbed depreciation, whichever is lower as per books of accounts, not as per Income Tax Act, but as per the Companies Act. If you have any loss brought forward or any unabsorbed depreciation, you will reduce whichever is lower of the two. And in case you have got unabsorbed depreciation for last 5 years, and in case you've got brought forward losses also for the last 5 years, you can accumulate them together, then calculate whichever is lower, and you can make the adjustment, right? So these five adjustments are clear. Adjustment number 6, 7 and 8 are now not relevant, so they've not been removed, but now they are no more relevant. Coming to adjustment number 9, which is related to the profits of sick industrial companies for the assessment year relevant to the previous year, in which said that the said company became the sick industrial company. So in case there is any sick industrial company which has got some profits, those profits have to be reduced, because we do not want to charge minimum alternate tax on the profits of the sick industrial companies. So these are the 9 negative adjustments. We have seen 8 plus 1, and now we have 9 positive and 9 negative adjustments if you look at like that. Now these lot of adjustments are there, so you might be feeling confused as to how am I going to handle these many data and information. How do we handle these situations? So for that, we would be doing some 3-4 practical questions on this particular concept. I have just given you the theory of this concept today. In the next class, I would be continuing with the same topic, where I would be discussing some practical questions on these concepts with you, right? So today I would not be sharing, tomorrow I would not be sharing the slides of this particular topic with you. You can read it from your books. Whatever queries you have, you can bring it to me in the next class, and then we can continue from here in the next class. Anything now that you want to say? Anything that you want to say? So any doubts, any questions, any queries? Nothing is coming. So I think we can close the discussion for today. I hope you were able to understand the concepts that we have discussed in today's class. Though it will take some time for you to understand them completely, it would need a lot of practice as well. So you have got now 3-4 days till Monday. We don't have any ATLP class. So you can use this period in order to read through the chapter, to understand the concepts, and then we meet again on Monday and discuss the concepts in greater detail, right? So with this, good night and bye-bye to all of you. In case you want to give any feedback, the feedback form will get uploaded after you close the session, so you can give the feedback there, or you can write to me on my email as well in case you want to say anything. And you can access through the archive from the same link from which you have entered in the class. So with this, bye bye, good night, and thank you all for your patience at the time when the power had actually gone off. Thank you so very much. Good night, and see you in the next class.